Welcome back to The Explainer. Today, we're jumping right into something pretty wild in the AI infrastructure race. We're looking at Cerebras Systems. You might know them by their ticker, CBRS. Recently, their stock just went on an absolute tear, surging over 15% to close just shy of $252. And this all went down right before their highly anticipated supernova event out in San Francisco. But, while massive stock moves are flashy and grab all the headlines, they really don't tell the whole story. To figure out what's actually going on here, we have to bypass all that hype and look at the real, hard data driving this narrative. Okay, let's dive into this. The very first number you absolutely need to wrap your head around is 103%. That is exactly how fast Cerebras' core revenue grew year over year in their second quarter, hitting a whopping $209.9 million. Now, keep in mind, this is a non-GAAP measure, but management uses it to show the real underlying trajectory of the business. And I mean, a core business literally more than doubling its revenue, that is just an extraordinary growth rate for any semiconductor company, hands down. But as impressive as that is, it's really just the baseline. Because that brings us to an even more explosive figure. Check out this next number, 287%. That huge percentage represents the massive growth of their core cloud and other services business over that exact same period. And honestly, this brilliantly illustrates a major strategic shift for the company. See, Cerebras isn't just trying to make all of its money off of one-off hardware sales anymore. They aren't just selling a chip and walking away. Instead, they're building an entire business around AI compute delivered through the cloud, which creates this beautiful, recurring, ongoing compute usage.
So you might be wondering, why is this cloud growth happening so incredibly fast? Well, that brings us to section 1, the AI inference boom. CEO Andrew Feldman is betting heavily that this is the next major wave in AI. Think about it like this. The first phase of the AI war was all about training. It was just brute force computing to actually build and teach the models. But the real volume play going forward, that's inference. Unlike training, inference happens over and over and over again, all day, every single day. Every time you ask a chatbot a question, that's inference. It's a massive, recurring, daily workload. And that is exactly the gold rush Cerebras is targeting to generate long-term, sustainable revenue. Now, what's really interesting about this slide is how Cerebras tackles this inference demand. It's totally different from the conventional GPU approach. Instead of stringing thousands of smaller processors together, like trying to communicate across a giant puzzle, Cerebras' unique wafer-scale engine is literally one enormous processor built across an entire semiconductor wafer. It's huge. This keeps the AI model weights directly on the chip itself, which virtually eliminates those annoying communication bottlenecks you get when distributing workloads across separate processors. The result? It delivers the ultra-low latency that inference absolutely requires to feel instantaneous to the user. And they aren't just talking about these speeds in some theoretical, perfectly controlled lab. Cerebras has a very high-profile demonstration of this architecture, proving its absolute worth in the real world, and it's with OpenAI. Their technology actually powers OpenAI's new GPT 5.6 Sol ultra-fast mode. In this specific deployment, the system is reaching staggering speeds of up to 750 output tokens per second. That is blink and you miss it fast. They're taking frontier AI models and making them respond dramatically faster. For inference workloads, speed is quite literally everything, and Cerebras is clearly positioning itself right at the top of the pack. But as we all know, having the fastest chip in the world is really only half the battle, right? Which brings us smoothly into section 2. Scaling the infrastructure, and what it actually takes to capture all this insane demand. Just take a look at this eye-catching number, $25.4 billion. That massive figure represents Cerebras' remaining performance obligations. It's a huge deal because it gives investors incredible visibility into their contracted future business. But, and this is a really critical caveat you have to understand, this is not $25.4 billion sitting as cold, hard cash in Cerebras' bank account today. No way. It is not guaranteed near-term revenue. They actually have to physically build the infrastructure and successfully deliver on those services before they see a dime of that money. And fulfilling those massive obligations, it requires an unbelievable amount of physical scale. First off, they have to expand their actual wafer supply and manufacturing through heavy-hitting partners like TSMC, Flex, and Sanmina. Then, they have to physically build out the servers and all the complex networking equipment. And finally, here's the absolute biggest hurdle of them all: electricity. Cerebras plans to scale its data center capacity to deliver a massive 600 megawatts of power by the fourth quarter of 2027. To put that into perspective, that's enough power for a city. We are shifting the story here from just printing silicon chips to securing major real estate, massive energy grids, and giant cooling systems. And honestly, navigating that massive infrastructure scale brings us right into Section 3, the profitability problem. This is where we look at the bear case for the company. All of this spending forces us to ask one fundamental question: can the economics actually work? A company can grow its top-line revenue by spending enormous amounts of money, but that definitely doesn't mean it's a successful, sustainable business. And the headline numbers here, well, they look pretty tough. Cerebras reported a massive GAAP loss of approximately $450.5 million in their second quarter alone. Ouch. So the crucial point here is context. Actually, scratch that initial shock. When you dig in, that massive GAAP figure includes significant non-operating and accounting items. When you look at their Q2 adjusted loss, it was actually just 5 cents per share. And that easily beat Wall Street's expected loss of 17 cents per share. So the underlying operating picture is much, much better than that giant headline loss suggests. However, let's be real, the company still expects core operating margins to be negative in 2026. Basically, they are asking investors to believe that today's heavy losses are just absolutely necessary investments for tomorrow's massive scale. And management is totally backing up that belief with some incredibly aggressive targets. Just look at this chart. For 2025, they expect roughly $510 million in core revenue. But their 2026 target requires an aggressive leap up to $885 million. That is a 74% growth jump in a single year. And they even expect revenue to more than triple by 2027. This explains exactly why the stock is so volatile right now. Wall Street is trying to price in this exact, highly aggressive future today. That means any little hiccup in their infrastructure build-out could completely disrupt the whole valuation. All right, this brings us to the ultimate industry showdown. Section 4, Cerebras versus Nvidia. Can a radically different architecture truly carve out meaningful market share against the dominant incumbent? Let's break down the current landscape. Nvidia is the undisputed titan here, for sure. They have the deeply entrenched CUDA software ecosystem, enormous cash flow, and deep historical ties with literally all the major hyperscalers. Cerebras, on the other hand, is taking a completely different, highly specialized route. Their focus is purely on ultra-low latency. And instead of trying to just go it alone, they're actively integrating into the broader ecosystem. They've teamed up to integrate with the AMD Helios platform, and they have major deployments rolling with Amazon Web Services. They clearly want to be an essential piece of the infrastructure right alongside the other established giants. So when we synthesize everything we've looked at today, we are basically left with two very clear paths. On the bull case side, ultra-fast inference becomes the defining metric of the industry. The recurring cloud revenue continues to scale exponentially, and they successfully convert that massive $25.4 billion backlog into actual realized cash. But on the bear case side, Nvidia and AMD simply improve their own inference speeds. The big hyperscalers just decide to build their own custom silicon, and Cerebras finds that all this incredibly heavy infrastructure spending just doesn't lead to improved profit margins fast enough. It's a classic, high-stakes technology showdown. We know the AI chip war has moved way beyond just who makes the biggest GPU for training. It is now entirely about who can deliver inference the fastest, at the lowest sustainable cost, and at an enormous scale. Cerebras is betting billions of dollars that its wafer-scale engine is the ultimate answer. But that leaves us with one final provocative question for you to really think about. Will a radically fast architecture actually translate into sustainable, durable profit? Can sheer speed and cloud scale truly overthrow the established GPU empire? It's a multi-billion-dollar question, and the answer is going to shape the entire next era of technology. Thanks so much for joining me on this explainer. I really hope this helped clear up the incredible numbers behind all the noise. Keep learning, and I'll catch you next time.